You know, my body can strike me down and incapacitate me, but they can't keep me from my charts. You could throw me in the hospital and do all kinds of tests on me, but you can't keep me from my charts. You can drag me kicking and screaming into surgery and rip my guts out, but you can't keep me from my charts. I want to apologize. I wasn't able to post yesterday, and I'm posting late today. I had a medical emergency. Got really feeling sick. Went to the hospital, got a bunch of tests, and they told me I needed emergency surgery. So that's why I haven't been able to post. I'm really sorry about that. Even in my hospital bed, here I am talking about the charts. You can't keep me from my charts. You can do almost anything to me, but you won't be able to keep me from my charts. And I'll try to post at normal times tomorrow, back on a regular schedule. Wanted to do a quick update again. We had the rising wedge breakdown on the S&P 500. We had the divergence. We gapped lower last Thursday, and we were not able to fill the gap. I talked about possibly filling that gap. Told you we didn't have to fill the gap, but we still might try to fill the gap. And we had these black candlesticks on the 60-minute chart. You broke the 50 with yesterday's gap, and then you came down towards the 200 period moving average, the black line right there. You attempted a rebound. You're up 0.37%, up almost 25 points on Tuesday. After gapping lower on Monday, another gap to be watching at 68.52. Again, we're eventually headed down to 65.50. The gap at 68.92 never filled. It doesn't have to fill, but it could. Had a rally, but then we didn't close at the highs. We had rallied up to 68.29. We closed down the last hour of trading there, down here on the 60-minute chart, down to 67.96. Still up, but not at the highs of the session. Again, we likely have a head and shoulders forming. If we lose the cloud, we lose the 200 period moving average, you may get a bigger push before you get any kind of meaningful rebound back up. If you get one at all, you don't have to. If we just get a complete reversal here, coming back and filling these gaps, again, you're coming back and filling these gaps here, this one here, down over here, just below it, the 200 period moving average. We had the gaps above the upper Bollinger Band in the daily time frame. So again, going to be watching, do we take out that 200 period? And if we do, if we hold below it, you hold below the cloud, again, you may come on down over here. It may be that we end up getting a bigger drop before we get any kind of any kind of meaningful bounce. Be watching to see if a divergence eventually sets up on the hourly chart. So far, we don't have one, and the MACD stochastic turned up, but trying to roll over here just above the 50 level. So again, things playing out accordingly. I told you if I was wrong about the turn right here and the peak right here, that we might get back-to-back reversal bars in the weekly time frame. So far, the reversal with the Fed is playing out. And the S&P down almost 2.5% from the high to the low with the reversal with the Fed. And remember, the Fed canceling the December cut. They're not going to cancel it. They're going to end up doing it, and then by January, they're likely going to be doing jumbo cuts. They may do it by December, but again, by January, they're going to be doing jumbo cuts. We're going to get the cuts everybody wants, but it's going to be for the wrong reason, because recession is about to start. Please support the channel with the link directly below. That allows me to be able to provide you this information. If you like the charts, you like the indicators, let me know that by supporting the channel today. If you could take a moment to do that, I'd really appreciate it, because I choose not to have sponsors. Take a moment and just follow the link below and just do what you can to help out. I would appreciate that. Thank you for your consideration for that. The VIX still holding above the 50. The VIX got above the 200, but turned down off of it yesterday and tried to get above it today, turned down off of it. As long as the VIX holds above the 50-period moving average, bad things happen on the S&P 500. Again, the MACD is firming up here at the center line. Again, we're seeing all the same things that happened back over here with the VIX. The warning signs before the 21% sell-off in the S&P down here. The VIX firming up, the tightening of the bands. The MACD getting into positive territory, now firming up at the center line. Very similar here. It went negative and then firmed up. Here it went negative and firmed up. Here it went slightly negative and firmed up. Very similar. And again, surging above that 50. If you can get above the 200 and close and stay above the 200 period, you're going to see a bigger drop. And again, it was associated, the firming up of the MACD associated with these surges in volatility. You had the breakout of the bullish falling wedge, the breakout of the bullish falling wedge. So again, the VIX is sending warning signs, but people are too busy saying, oh, the VIX is broken. This time it's different. When Powell was asked about the AI bubble, this time it's different. This time you have real earnings. He's really concerned about his legacy on the way out the door. That's why you're seeing Powell panic with the banks right now, and that's why you're seeing try to downplay things. This must be much worse than being led to believe if the Fed's just kind of downplaying things like at the press conference and now Fed injecting billions into the banks. Yet it's just quietly being ignored. Something's coming down, man. Don't be naive. I'll try to post tomorrow at regular time. I got a lot more to share with you. Now again, we have a potential head and shoulders here that's setting up if we end up dropping back to 65.50. This was where Trump did the 100% tariff threat on China. There's no confirmation and follow through to that bar in the daily time frame. We had that diversions play out in the 5-minute time frame. We slammed into major resistance to the weekly time frame the day ahead of the Fed, and then with the Fed we slightly overthrew that level. You got a gap and trap, and so far we've dropped below the 200 period moving average here. The 50 dropped below it, and the 200 has been acting as resistance. We tried to overthrow it here, and we turned right back down. Right now we tried to overthrow it. 50 got back above the 200, but price dropped back below it. So if we do attempt a bigger recovery, again, the gap fills 68.52, 68.92. Those are the levels to be watching. We've become oversold here. So again, do we in the 5-minute time frame? So do we attempt a recovery? Try to fill today's gap, yesterday's gap from Monday, and then I'll be watching if we do what happens to the gap over on last Thursday's gap. Lost that 200 period here in the 15-minute time frame. The 50's crossed below it, so that is a sign of weakness. The MACD is rolling over, so again, it could still be that we get more downside before we get any kind of meaningful bounce. We'll be watching these gaps closely on the intraday charts. We still may attempt to fill one or both of them because we came down to this trend line right here. Now again, if we break this trend line, you're going to lose the cloud, the momentum cloud. You're going to lose the 20-period moving average, the blue line right there, and you're going to lose the trend line. So cloud, the 20-period, and the trend line are acting as support right here. If we bounce, watch those two gaps, 68.52, 68.92. Meanwhile, the MACD is now rolling over. The stochastic has broke 50 or 80, pardon me, and we potentially have a 5-leg push higher completed and now starting to move what I think will take us back down to the April low. S&P daily here. I guess what's going to happen is we're going to end up taking out the 50-period moving average. And let me move this down so you can see the price action here. I think we'll come down, take out the 50, and end up taking out the cloud eventually. Again, these gaps do not have to fill. They may not get filled. That trend line of support. So do we bounce? We're at the 20 period. Again, I think you're eventually going to be down here by January, down towards 48.35. The MACD is completing what looks to be completing the diversions right here. So again, I expect something's going to happen. I just want to say one thing. I'm thinking about it. There's something going on right now under the radar. Right now, I told you we've got problems with the regional banks. And the Fed is downplaying this, not focusing on this at all with the last Fed meeting. Told you it's going to go up. It's going to show up. You're going to start hearing more about this. We're hearing little bits and tiny pieces. Stories hidden. Fed is pumping cash, injecting billions of dollars into the banking system right now. Why are they doing that if everything's so hunky-dory? If everything's fine? Told you, you're about to have massive stress in the credit markets. The Fed is pumping massive amounts of money into the banking system last few days. I heard, the Fed, liquidity. The Fed's doing this because the banking crisis is about to start. The regional banks, sour loans. The Fed's about to start quantitative easing. They're still doing quantitative tightening until December 1st. This is how far gone the herd is. They're doing this because trying to stave off another financial crisis that's about to happen with the banks. Powell was just asked at the press conference, is the AI bubble at risk of popping? And this isn't like, Powell said, this isn't like the .com bubble where there was no earnings and just ideas. This time it's different. And we had a reversal from that day going forward. I told you that at the time. Those red bars on the oscillator, we tried to get, at the lows of the session, we tried to get a reversal of conditions with momentum. We're below the 10 period, but we're holding above that 20. You're holding above the cloud, closing above the cloud. You need to close below the cloud. So you need to see that happen for momentum to shift. And then you need to see my trending signals turn to bearish if this is going to get validated as a peak and a reversal. The MACD now rolling over. So we'll see if we get a bigger drop to the 50 to take it out, to test horizontal support and the potential head and shoulders here in the daily time frame. If we confirm the Gravestone Doji, we need to close below it, eventually take out the 10-week and get a reversal of conditions here in the weekly time frame. You got a red bar in the oscillator. You got the divergence going on the MACD. You've got the divergence going on the stochastic, the RSI, which is not seen here. Have the red oscillator bar for the NASDAQ yet. You got that divergence on the stochastic. I expect you're going to see the stochastic roll over here either this week or next week. We'll be watching for confirmation to the Gravestone Doji, the shooting star candlestick on the NASDAQ. NASDAQ daily charts playing catch up to the S&P 500. Again, we're below the 10 period. We're finding support at the 20 period. Tried to take out the lower boundary of the cloud today to get a bearish reversal of conditions. You couldn't do it. We rebounded off of the lows, and you ended up getting the rally. We were up 184 points, up 0.72% after moving slightly lower than Monday's low, but still getting rejection at that 10 period. You lose a 20, you get a bearish reversal of conditions, you get the bigger drop. The MACD right here about to roll over. We got a reading of 3. We got a reading of 0.33, so we're barely above the center line on the histogram. Once that goes negative, the crossover happens. You have it on the S&P 500. This is the S&P 500 right here. It's diverging with credit, the credit markets. This is the credit spreads right here. It made a higher low. It already bottomed, and it's diverging with the S&P 500. You're now beginning to see the early signs of stress in the credit markets. Here's another view right here, starting to see that after a September low. If I zoom out here, last time we saw the stress in the credit markets was during the sell-off during February to the April low down over here. Prior to that, 2022. Prior to that, 2020, 2018, 2015, 16, 2011, 21% sell-off back over here in 2007. Early stages of the subprime mortgage crisis that evolved into the financial crisis during the 9/11 attacks and the bursting of the .com bubble there led to these bear markets. And again, I keep warning you, still this larger divergence back over here from early 2025, right here with the S&P 500 in the lower window. This is the S&P weekly chart. We're starting to see the early stages of stress in the credit markets returning. You're going to see it go up. You're going to see a big sell-off, and then calm down, and then you're going to be seeing something much, much bigger after we move into the recession, and you'll get a black swan, which will likely be something related to the regional banks. The recessions are usually related to a credit-driven issue, which is what we've seen in the past. This is what I keep warning about. You've got the fear of recession with recession indicators flashing. We got the government shutdown. I keep telling you, this is going to go on longer than everybody thinks. What is this now? Day 36? Now we're beating 35 days, right? Today's day 36, right? 31 days in October, 36 days. Now the longest government shutdown in history. I told you it'd go on 5, 6 to 8 weeks, maybe longer, 10 to 12 weeks, 3 months. I'm going to put the final nail in the coffin to ensure that the U.S. goes into recession. Well, I told you it's going to be going on longer than everybody thinks. People now saying, oh, it's now going to end now that the elections ended, this week. This is what they said a couple weeks ago back with the D.C. rally, that it was going to end back then. It didn't. Again, I think that shutdown is going to go on longer than everybody thinks, and concerns about recession are going to start kicking in. Starting to see evidence of stress in the credit markets, getting early stages of it. Pay attention to what's going on with the Fed and the banks right now. This is being done very quietly. Liquidity is drying up. The Fed is quietly signaling, according to the Economic Times, the Fed is quietly signaling trouble ahead. Powell injects, this is from October 31st. There are other articles, but since then, Powell's injecting billions into the banking system. Biggest repo operation since 2020 as bank reserves crashed to $2.8 trillion. The Federal Reserve just made a huge move. Few notice it. Notice what the Economic Times is saying. Even on social media, some people that pay attention to economics that are talking about this stuff, very, very few. Oh, the stuff I'm seeing. Oh, the Fed, they're starting QE again. And I mean, just these people are so delusional in their herd. And the moon boys are so far gone. Doing this because a banking crisis is on the horizon. That's why they are doing this. Talking about this, some evidence of it. Already with the sour loans and some real problems at a couple of the banks. Hear more about this. Keep warning about all of this. We've got warning signs with the 10-year yield breaking out of the bull flag or the bullish falling wedge above the 50. It was up another 1.66 today, 1.66%. The MACD is now moving into positive territory. You've got the bullish divergence on the MACD and the RSI. The RSI has already moved above 50. The bullish divergence playing out. Remember, we saw this very same thing happen during the 2022 sell-off. You still may see Jamie Dimon's crack in the bond market have a negative correlation with yields and with the stock market. You could see the yield surge and the stock market sell off. About this possible wave 4, and we get a wave 5, and we see this surge. Now, again, I don't know that it plays out this way, but I'm just telling you, we're seeing the breakout in the daily time frame, and you get this consolidation here. Something worth paying attention to, that the yields are surging and the dollar, that bullish diversions play out, surging back up to the 200-period moving average now. So again, pay attention to what's going on. Dollar surging back up, bottoming, surging back up could be bad for Bitcoin in the stock market. Keep pointing out the dollar has bounced off a major channel parallel to the upper channel here, bottomed out, and again, begun to rise. This is what we saw in 2022. Other periods where there's been major sell-offs, something worth paying attention to. I think the dollar is eventually going to surge back up to this upper channel over time into 2026. Could be marking a reversal for Bitcoin, and then Bitcoin peaked. Shortly after that, you've seen the stock market. That's what happened in 2022. 2007, we got the Fed cut. The market went to a new high, but we started seeing sell-offs surrounding the October and December cuts, and eventually by January of 2008, after the two cuts there, they eventually panicked. That's why I keep saying in December or January, you're likely going to have the Fed panic. It's probably going to be January. It might be in December. If we sell off sharp enough, Fed is already signs of concern with injecting billions into the banking system. So again, I wouldn't ignore this. Yet people do. Oh, QE is coming. Here we go. Warned you over the weekend that on Friday, the S&P bullish percentage index, and this is looking at stocks on the S&P that are in uptrends and downtrends, and the bullish percentage, we rested right at 50. I told you if it breaks it, like we did back over here, again, you're likely going to see something like that happen. Only it's going to be bigger than that. You're likely coming back down to this level, and you're probably going to see a 26 to 30% drop, maybe more if we take it out, we could do. To price it, the market's going to price in the recession. We're going to kick off the bear market with a crash. It's going to be bigger than this one we just had over here. This is warning you that something's wrong. Now below 50 in the upper 40s now. Hit a low of 45. We closed at 46. Again, this is warning. You're likely about to see this over here like what we had in February to April. Got that bearish divergence in the weekly time frame. I told you the gravestone doji has to be confirmed. Right now it is, but the week is still young. We'll see what it looks like by the end of the week, and then we need to come down and take out the 10-week moving average. I told you I expected a rally back up, but then to confirm this candlestick by the end of the week. I told you if I'm wrong about this being the turning point, this being the peak here, and the top, that we could form back-to-back reversal bars. I told you I didn't think that was going to happen, but I told you if I was wrong, it could, and we'd slam up into resistance. So right here, we turned off major resistance, getting this gravestone doji and this topping tail. I don't know the future. I tell you what I think, but again, I told you if I was wrong, you'd see back-to-back, likely back-to-back reversal bars at key resistance. I think I'm going to end up being right, and because I saw evidence of a peak there with the channel of resistance, hopefully the weekly time frame, the warning signs I already talked to you about over the weekend, and by the end of the week we will confirm here. We'll see what the bar looks like by the end of the week. Big ugly red bar by the end of the week will not only confirm this, but it will also be a reversal bar where you open higher, where there's no topping tail, and you close down. Talk about that over the weekend if that candlestick forms. I don't have time to do it today. It's a reversal bar in and of itself with Japanese candlesticks. I told you we had that those closes above the upper Bollinger Band in the daily time frame. We got that hanging man candlestick. We've had a confirmation of that candlestick. Yesterday, I was not able to post. We got a follow-through to that candlestick. We're below the 10 period. We're still holding above the 20. You need to take out the 20 and the cloud, make your way down to the 50, make your way down here to the lower band and horizontal support at 65.50. And again, if we've got wave 1 and 2 done, then you could be in wave 3 here. We'll be watching this gap fill, and the gap fill up here, we never did fill it. You don't have to fill these gaps, but you could. But again, it's possible you have wave 1 and 2, and you're now possibly in crash wave 3 in this first push down with these smaller subwaves. So pay attention to that. Again, we're likely headed down here. Now have the MACD rolling over. The divergence is now complete. So again, I wouldn't be ignoring the drop here below the 10 period moving average. Now again, still got room to fill a gap or two maybe. This one might be less likely if we get a more of an intraday rally, but pay attention to what's going on here. Head and shoulders in the daily time frame here. The S&P closed, it was down as low as 67.63. We took out yesterday's intraday low and we closed higher, closing up for the session, but we closed at 67.96. Intraday low was 67.63. Keep that number in your mind, 67.63, 67.96. Because remember I told you that that 67.50 area, 67.50, if we break it, then we can go down to 65.50, which is potential neckline for a head and shoulders pattern. And if you break 67.50, you're going to be turning many of my signals back to bearish, my trending signals here in the daily time frame. Did a good job of marking the rally up, sell-off down, but we've only had mild corrections. This one will likely be a major sell-off, produce a reversal to kick off the bear market in the S&P 500. And this is going to probably drop down to the April low until January, and that's when I think the Fed is going to panic. in January. They'll do an emergency meeting, have emergency rate cuts, probably half a percent or 0.75%. My guess is it's going to be 0.75. Powell's really concerned about the banks, I think, and again, the whole thing is being downplayed, likely starting the banking crisis right now. We'll sell off down to a January low. The Fed will panic. They'll do massive jumbo cuts, and the market will rally back up, likely up towards this level, and you'll probably get that head and shoulders that I talked about. You'll probably sell off and then come back up, and again, either to this low or towards it, channel in the weekly time frame that I've talked about. NASDAQ right there as well. Look at that. NASDAQ right there at Q support. It breaks it. You're going to start seeing my signals turn back to bearish. I thought we had something like right here where we turn back to bullish briefly and then it's going to revert and you're going to get a big drop right there. The signals remain bullish. I think they're about to turn bearish. And if we start crash wave 3, if we've got 1 and 2 done, we're in crash wave 3 right now, you're going to see a pretty dramatic drop. Watching these gaps. Same thing for the NASDAQ. Does it fill the gap we just had, or is it a gap and go and we just start gapping down? We'll be watching the gaps. What I'm watching is to see, do my trending signals start turning back to bearish in the daily time frame and validate the topping tail in the weekly time frame that we saw form last week, the gravestone doji, the S&P, and the shooting star topping tail on the NASDAQ. NASDAQ 100 right here. S&P. So do we break lower and start seeing my signals turn back to bearish? Do we go up and try to fill Monday's gap lower, possibly last Thursday's gap, but I'll be watching those open gaps from last Thursday and from Monday. If we do turn down, again, do my signals start turning back to bearish, confirming the topping tail in the weekly time frame? NASDAQ daily chart. Keep in mind, Bitcoin has already collapsed by 20%. I predicted turned off resistance at 126,000. It would go down to 100,000. It has. Bitcoin has already topped. This is likely a top right after Bitcoin. That's what happened in 2021. Bitcoin peaked, market peaked right after it. These gaps, again, maybe they get filled, maybe they don't. Maybe, there's no rule that says they have to be filled. I know some people will say that and believe that, but there's no rule that says it has to be filled. It may get filled at some point way into the future. We don't know. Got this head and shoulders potential pattern here on NASDAQ as well. Again, be watching to see, do we take out these 200 periods? And if we do we head down towards these October 10th lows? Back and filling the gaps as I told you we would. Oh, gee, what's happening? We're filling the gaps. Got this really big divergence going on here in the daily time frame. Again, just like the S&P, we're coming down to the trend line from the April low. And again, you break this level, get the bigger drop. Bounce off of it, you can maybe try to fill the gaps. If we come down and break it, the right shoulder may be the back test. So keep that in mind on the NASDAQ. Similar back test to on the S&P 500 could be the right shoulder. If the S&P drops, breaks the trend line, which again is likely going to happen, you could come back up and back test the trend line. That could be the right shoulder and maybe fill that gap in doing so and have kind of a lopsided head and shoulders. So we may fill this gap right here from Monday with the right shoulder if we continue to drop and break this trend line. So be aware of that.